Hello and welcome back to The Note, coming to you this week from our offices in New York. Now, the topic for today is emerging markets. We've heard frequently recently that emerging markets are cheap, but are they cheap for a reason? Last week I spoke in Seattle to Arjun Divecha, who's the head of emerging markets for GMO. He argues that emerging markets really are worth buying, and I started by asking him why. Arjun, thank you very much for joining me today.
Thank you.
Now let's start by taking a look at this very interesting chart you put together linking GDP growth with subsequent equity market growth, which basically shows that if emerging markets are slowing down, that doesn't necessarily tell us anything about their stock markets.
Well, it's a better metric of one emerging market relative to another. What the basic chart shows is that there is no correlation between recent GDP growth and future return in the stock market. And in fact, countries that have grown slow in the last 5 years tend to have better performance in the next 5 years, or next 1 or 2 years, than the ones which have grown fast.
So the implication, obviously many people are concerned that China will be growing, it might well still be growing, but it will be growing slower than it did in the past. That's not necessarily as bearish for stock markets as one might think.
No, I think it depends on, valuation matters more than everything else. So the question is really, what do you pay for it?
Right.
Rather than, is the economy slowing or not? I mean, yes, in the short run, economy slowing and speeding up do obviously make a difference to corporate earnings.
Okay, now let's take a look at one of the most controversial sectors out there, which is Russian energy companies. Many people have noticed they are quite spectacularly cheap. I believe you pay less than 3 times earning to buy Gazprom, and we all know why you might be nervous to hold them, however.
Yeah.
I gather you do hold them. What are the arguments here?
Well, the argument is quite simple. I have a saying which is that you make more money when things go from truly awful to merely bad than when they go from good to great. So this is a case where you're being richly paid by the market for taking on all the risk that obviously everybody perceives.
Okay, and your chart shows that there's a pattern of persistently underestimating what those big energy companies are going to do.
Well, that's the other interesting thing. If you look at the West, if you look in the US, for example, and you look at what are the forecast earnings that analysts come up with, almost inevitably you find that they overestimate, that the analysts are 15% typically over-optimistic. But what the chart shows is that that's not been true for Russian oils. This is what I call the discrete charm of low expectations.
Okay, if we want another example of low expectations in emerging markets, Chinese financials. Many people are very scared about them. They're very cheap. Again, I gather you do hold them.
We do hold them. Again, Chinese financials are a little bit more complicated because unlike an energy company where you do know how much gas or oil they actually have under the ground, and it is generally correct.
Yes.
With a bank, you really never know what's really inside its balance sheet. So, banks in general are more obtuse, much more difficult to value. But yes, certainly if you look at kind of the surface metrics, the Chinese banks really do look attractive. And we think that some of the banks at the top of the food chain especially will do fine because they have had the luxury of not having to buy the crap that everybody else has bought into.
And is there any sense of a government put there as well? Presumably they're too big to fail, which might be bad for the system, but it's good for investors.
There's no question that these banks will not fail, the big banks will not fail. The issue is that how do we as minority shareholders get treated in that kind of a circumstance?
Okay. Now one final fascinating point you've made in your presentation at the conference here is we're looking at GMO's general forecasts for asset class returns over the next 5 years.
7 years.
7 years, I'm sorry. Emerging markets come out top among all the conventional asset classes, topped only by timber.
Yes.
Explain to me how you drew up this chart, and also tell me a little about the charms of timber.
Surely. So basically the way that we come up with these forecasts, they're typically 7-year real forecasts, so it's in real terms how much money you'd make. And they're really based on 2 things. They're based, number one, on valuations. So what the chart shows, which you've obviously alluded to earlier on, is that emerging markets are cheap, whereas the developed markets are not as cheap. The second piece which is important to is margins, or corporate margins. So the idea being is that when margins are at an all-time high, like they are in the US, the likelihood is that they will mean revert to their kind of long-term averages, so you have kind of a double whammy effect. That is, the valuations go down and margins go down, that's bad. Conversely, in emerging markets, margins are not particularly high. They're not particularly low, but they're not high like they are in the rest of the world. So that's why we like emerging relative to some of the other equity markets.
And as for timber, if neither of us is an expert?
Yeah, well, we see timber as a very attractive long-term asset, and at some level you get rewarded for taking on the illiquidity. Because typically, as an institutional asset class, you need to hold these things for 10, 15, 20 years. And since there's not much of a clientele who are willing to make that kind of a bet, they get priced, essentially from the point of view of rewarding you for that illiquidity.
Okay, Arjun, thank you very much indeed. The debate over emerging markets will continue to roil, but what I think is clear is that if you really want to try to beat the markets in the long term, you have to be prepared to invest in some things that might cause you to make a sharp intake of breath, such as, for example, Russian energy companies or Chinese banks.